Good morning and welcome to the Inkle Expert Access Series. Joining us today is Kyle Green, the owner of Green Mortgage. Kyle Green is the king of getting complicated deals financed in Canada. He brings 17 years worth of mortgage broker experience and has specialized in the investment niche since 2008. He is a go-to mortgage resource for accountants and real estate investors. His years of experience working with national investor groups, including the Real Estate Action Group, have equaled rewards and recognition only fitting for someone of his caliber. Owner of two mortgage brokerages, Green Mortgage and Origin Mortgages, that fund over $1 billion a year, he has published articles in a multitude of publications, including the Vancouver Sun and the Western Investor. He co-wrote a best-selling book, Rockstar Real Estate Investing, and is also the designer of the cash flow analysis spreadsheet, which became a huge hit after being used by thousands of investors across Canada. Thank you for joining us today, Kyle.
Of course. Happy to be here.
Excellent. So I'd like to start with a few questions around your background. Help us understand how you got into the profession.
Yeah. Interestingly, I guess when I was in college, I remember having a teacher, accounting 201 teacher. And after class, we were chatting a little bit and he started to mention, I can't remember why we got up to this point, but he started to mention that his brother was a stockbroker and his brother had a Porsche and a yacht and all that stuff. And so sure enough, I'm like, well, I like Porsches and I like yachts, so I think I'm going to be a stockbroker. So at the ripe age of 18 years old, I started looking around for jobs in finance. Nobody wants to hire somebody that's 18 years old that's in college to get a finance job. So I did eventually get a job at a credit union here called Westminster Savings Credit Union, and I was a teller. I think I landed the job right when I turned 19 years old. But then five months in, I realized that the union environment was not a good fit for me. I was used to, working a lot and also, I guess I've always had that entrepreneurial spirit of you put in and you get out what you put into it. I realized that the union environment of having steps and layers to your income, it was going to take me 10 years before I can crack six figures. That's not Porsche money right there. So, as talking to a friend of mine on MSN Messenger, she said her parents were looking for some help doing some boring paperwork stuff. I thought, okay, well, I'll check it out. They were mortgage brokers. Started working with their company. And so that was November of 2006. I got into the business and 17 years later, here I am. So I guess I lucked out a little bit. I found a job where it really fits my core things that I really enjoy doing, which are people, money, and numbers. Always was very good with people, also very numbers driven. A lot of people are one or the other. A good accountant is really good with people and good with numbers, not just good with numbers, because you still have to explain it to people. And then just always being interested in money, not just like earning money, but also just in the money markets, I suppose. So yeah, it's been a good fit.
Excellent. So tell us a little bit about Green Mortgages. How do you add value to your clients, and how ultimately did you get to be in the top 0.1% of mortgage brokers?
Yeah. Well, I started working on carving out a bit of a niche for myself early in my career. So I got a little lucky. The company that I was working with, which was my friend's parents, they had about 25 franchises in British Columbia. And one of those franchise owners was a guy named Ozzy Durock. So he's a big real estate guru in Vancouver. He had a group that would meet monthly and then also would have large events, public speaking events every 6 months or so. And what ended up happening is they used to have somebody that was running the show there. That mortgage broker left, and then Ozzy was saying, hey, we need somebody to fill in. And he initially asked, of course, the owner of the company to fill in. He's like, no. He ended up saying, hey, you guys go. And you guys meant myself and the two daughters of the owners of the brokerage. The two daughters were, interested, but not as interested as I was. And over time, it made sense to brand one person. And that person was me. And so over time, I became the guy. I started doing all the speaking events with Ozzy Durock. Really quick, funny aside, actually, the first time that I spoke at an Ozzy Durock event, I had a booth. I had done this before, 6 months prior, I had a booth, and you'd sit there and here's this 20-year-old kid saying, hey, you need a mortgage, come over here. A few people would venture over. However, at this particular event, the other mortgage broker that was supposed to speak fell off a ladder, and or at least he supposedly fell off a ladder. There was another story that surfaced later that he got hammered the night before and drank too much, but who knows which one is true. But somebody else's situation was good for me, because Ozzy came to me and said, "Hey, Kyle, I need you to speak at 1:30," and I said, "I have no material." I peek in the door, there's 600 people in the audience. I'm like, holy cow, this is going to be a bit crazy. So we quickly did a Q&A style, because I can answer questions, no problem. And I had a lineup of people following me back to my booth. Everybody was talk mortgages, and way more people wanting to talk at that event than the previous event. So I think really developing a niche. And when you have somebody asking a 20-year-old mortgage broker, why should I use you instead of my bank or another broker? Yeah. I could actually say, look, I actually do more rental mortgages than most brokers that have been doing this for 5 years or 10 years. Because I'm specializing in this one specific field, and I just do this day in, day out. So even at a young age, working in a high producing office that did a lot of it, carving out the specialty, a lot of that business made a huge difference for me, and gave me the ability to then have a reason for people to use me instead of their own banker or another broker.
Excellent. No, thank you for sharing that. I love that concept of focusing on something, seemingly narrow and being an expert at it.
Yeah.
This actually brings me to sort of a good segue to my next question. And I think I asked you this the first time that we spoke. If somebody is thinking about getting in the market today, or maybe hasn't used a mortgage broker in the past, what is the advantage of doing so?
Yeah, well, a mortgage broker is effectively shopping 40 different lenders to find you the best rate and best product, and then we get paid by the lender, so we don't have to charge you a fee for our services. So really, we're just being able to go wider with it. And one of the reasons that I found this really useful is you can shop for rate, but you can also shop for product or access to capital. And so one of the things that I found was that as an investor, of course, you want the best rate, but actually what ends up becoming more relevant and important as you grow your portfolio is actually access to capital. So will you get approved or not? And how much will you get approved for? Because the way that the return on investment is calculated, the less down payment you have, generally speaking, the higher the expected return on investment is. And so if you're able to put the least amount down and access the most capital, that allows you to grow your portfolio quicker, which allows you to generally create more wealth more quickly. And so I found that being able to take in a client, being very, very meticulous in knowing all the lender policies, all the ways of being able to finagle and fit a round peg into a square hole, being able to do that. And there's lots of little tricks mathematically that I was able to do. And I've taught other brokers in my brokerage, et cetera, on how to do this. That other brokers, just if they're not as mathematically inclined, wouldn't quite notice or pay attention to. So I found that was the big reason for sure, is that really aligned with my client base, and being able to just find them more capital and be able to be a one-stop shop. The clients, I think they get frustrated when they go to a bank. They have a really good person, and that person gets promoted. Now they don't get to use them anymore. They have to get a new person, explain everything. They don't quite get it, and it's an uphill battle. Having one point of contact and just flowing, finding where the flow of capital is. Hey, TD Bank is really competitive today. And then next year, actually, it's Scotiabank that just changed their policies, and now all of a sudden it's RBC. Like, being able to open up the floodgates wherever the money is being flexible is good.
That's helpful. So you and I have had conversations about this before. Business owners, entrepreneurs often struggle to get financing. All of their money is tied up in their business. Maybe they have inconsistent income. Just give us a few words of advice for business owners. What can they do to really help their position when trying to get a mortgage?
Yeah, it's interesting. So here's the core concept that lenders typically look at when you're self-employed, or actually, in fact, not even just self-employed, but with income in general, is it's either the minimum guaranteed income you have or what you've averaged for the last 2 years. Now, if you're an employee, then you may have a minimum guaranteed salaried income that they can rely on. So the lender could use that. Or if you're making overtime or have another source of income, then they could look at, the last 2 years average if you have a little overtime or bonuses, et cetera. But when you're self-employed, there is no guarantee. And so looking at that and figuring out, okay, well, what number is the bank going to use? They usually use a 2-year history or 2-year average. Mm-hmm. Now, the challenge usually is that if you're doing your job as the accountant, what are you trying to do? You're trying to reduce the taxable income in general, right? And so you're trying to ensure that the borrower pays the least amount of tax. That's what the accountant's job is. The mortgage broker, on the other hand, says, well, my job is to get you the most credit and get the best rate. So I actually want the highest income because now I have more options, right? So it creates this tension between what the accountant wants and then what the broker wants. And in general, the best way to do that is to have both people get aligned together to figure out what's the minimal amount of income required to maximize the best mortgage possible. And there are some certain products that are available. So there's usually 3 different ways that you can get a mortgage done. If your income that you're claiming is not sufficient to qualify for what you want, or if you're just trying to pay less in tax, then the 3 options here are one is called stated income. So if you're putting less than, if you're buying a property that's less than $1 million, then you may be able to qualify for stated income. It's actually through one of the 3 mortgage insurers in Canada, so CMHC, Sagen, and Canada Guarantee. And what you do is you actually look through the financials and state the income at a reasonable amount. And so without going into a lot of detail, because I could probably talk for 45 minutes just on that, but you're trying to create a business case on what a stated income would be.
Okay.
Next option is what's called B-lending. So instead of looking at the corporate financials or the tax returns, instead, the bank is looking at the bank statements to see how much money is coming in and going out of that account. The downside to B-lenders is just that the rates and fees are higher. So in some cases, it does or does not make sense.
Right.
The third option, which we use a lot, is a lot of major banks also have a corporate net income program.
Okay.
If your company made $300,000 last year, but you only took $100,000 out and paid personal income tax on it, some lenders can use a percentage of that income, of that $200,000 that stayed in the company and did not come home to you personally. And generally speaking, you have to own 100% of that business for them to use that.
Okay.
So long story short, there's 3 different methods that you can use in order to qualify for a mortgage if you're self-employed.
Okay. No, that's very helpful. Thank you. Rates have climbed a lot since, I believe they bottomed in January 2021. Maybe I'm off by a few months there. But of course, we are seeing interest rates that we have not seen in a long time. What advice do you have for someone who needs to refinance in the next 6 to 12 months?
Yeah. So what we've been doing for a lot of clients lately is actually what I call a refinance pre-approval. The typically pre-approval is confirming, do you qualify or not? And also holding an interest rate. Usually for a refinance, you're not usually getting a pre-approval, but the reason I'm calling it a pre-approval is because we don't know if we're actually going to pull the trigger on this refinance or not. In a perfect world, interest rates stay flat or decrease as you approach your renewal date. However, lately, rates keep climbing and climbing and climbing. And so for some of our borrowers, it has made sense. If you get a rate hold and if rates go up 1%, it might actually make sense to break the mortgage early, pay the penalty, and get out of the lower rate that you have right now to secure a current rate that I've held for you for the next 3 years or 5 years. And so it's a mathematical formula, and it's just really coming down to what is the math. And at every one of these points in time, when we hold these rates, we often have thought rates can't go much higher than they are today. And sure enough, 2-3 months later, like, holy cow, they've really ratcheted up again. Mm-hmm. So if you have a renewal coming up in a few months, then that's something to consider, is that you can hold rates for up to 4 months in advance of your renewal. And in some cases, even if you're more than 4 months away from your renewal, it may still make financial sense to just get a rate hold and then see where rates go. Because if they keep climbing, it may make sense to pull the trigger. Mm-hmm. On the renewal itself, one of the strategies that we've been finding some of our borrowers have been open to is often there's 2 options. You just renew and keep the amortization the same as you already have. And a lot of the time, some lenders will offer better rates for shorter amortizations, like 25 years or less. However, sometimes we also say, well, there's another option. We could also refinance and stretch the amortization up to 30 years. And the rate is a bit higher, but the payments are lower. And in some cases, we found that clients that bought their first home 5 years ago, they went from 25-year amortization, now they're down to 20 years. And even though the rates have shot up, if they stretch the amortization up to 30 years now their payments are about the same. And
right.
So that's something that we've been doing quite a bit and offering both options. And a lot of clients have been opting for the lower payment option because of that, surprise of having that rate go. So,
Yeah, no, that's a great one. And what is the maximum amortization period that the large banks will allow?
30 years.
Okay.
And if it's an insured mortgage, so less than 20% down, then it's maximum 25 years.
Okay. Thank you. And will other lenders stretch beyond 30 years?
A few. So a few B lenders will stretch it.
Okay.
The occasional credit union in the past has stretched it, although most of the credit unions are no longer doing that. Some credit unions did go up to 35 years. But as of now, the only lenders that are going over 30 years really is just B lenders. And then the rates and fees are higher. So,
Okay. Thank you. So you had to know that I was going to ask this question. If you look into your crystal ball, where are rates going?
yeah, let's see here. Um, my crystal ball has not been working, by the way, the last couple of years. Nobody's crystal ball has been working the last.
No, I don't think so.
A lot of the economists, I mean, to put things in perspective, rates started to go up in January of 2022. And in May of 2022, on the rise, on the way up, the banks were predicting that the Bank of Canada might reach a prime rate of about 4.7%. We're at 7.2% right now. So just to give you an idea, and that was as rates were going up. It's not like a pre-rates going up process. And hey, by the way, we're probably going to normalize up here. It was out on the way up, quite a ways into the way up. And so people have been getting it wrong for quite some time. That being said, I still look at what people that bet on this are deciding, because usually people that are betting on it usually want to have good data on this.
Right.
So right now, the current expectation is there's an announcement next week, this week, that will be coming out regarding the Bank of Canada. The current expectation is that there's less than a 50% chance that they go up on this announcement. There's almost a 50% chance, however, the Bank of Canada does make one more move up on the prime rate of about a quarter point between now and the first quarter of 2024. And the current expectation is that rates will start to come down sometime in the second half of 2024. And so we might see one more prime rate increase, but that seems like it's either zero more changes or one prime rate increase until the midpoint of next year. And then we're likely to see the prime rate go down. On the flip side, fixed rates are based on the bond market, not the Bank of Canada. And the Bank of Canada does influence the bond market, but it's not quite the same. The bond market's in an interesting spot here right now because we might actually see a run up on bond yields, which actually would push fixed rates even higher than they are today. And the reason for that is that down in the U.S. in particular, there's some concern about the U.S. being able to service their debts. So they've issued and printed a lot of money. Basically, what happens when banks or central banks print money is they're actually issuing debt to print money. Right. And the problem is that they've issued a bunch of debt, and now all of a sudden, the interest rates on that debt are rising. And in order to pay the debt, they need to issue more debt so they can pay the debt. And that sounds like a pretty bad idea, doesn't it? So the problem is that now that the debt cost is rising, bond traders are saying, well, I think that the U.S. debt is riskier. And so they're actually selling off bonds, which makes the yields go up. And so we might actually see this crazy phenomenon where rates may continue to climb, even if the inflation is decreasing. Fixed rates may actually still start to climb because of this bond rate cycle. So be interesting to see what happens in the next little while. But we might actually see fixed rates short term go up and then eventually come down into 2024.
Interesting. Thank you. Let's shift gears a little bit. You wrote a book called Rockstar Real Estate Investing. I'd love to learn a little bit more about the book. So maybe just help us understand the general theme for those that haven't read it. And also, why did you write it?
Yeah. Well, let's start off with the why first, then I can talk about the what. So a friend of mine and I, both mortgage brokers in the business, we were hanging out at a conference. We're chatting, and we thought, I think we're done here. Maybe we should head out. And he said, yeah, why don't you come over to my place? We'll play some NHL. And I think he wanted to put some money on it. So I think we bet $50 or something. And unfortunately, I lost by one goal, and I had to pay him $50. But after that, we went upstairs. He said, I've got this really cool idea. I'm interested in writing this book. And there's this company that can kind of help with the writing process and with the publishing. It's about $25,000 to do it. And he thought, it'd be really cool if we just wrote the book together, because then we can basically chop the marketing fee in half. for writing the book. And we probably still get the full value of having the book be co-authored, so nobody really cares that it's co-authored. But the style made sense, especially if you have two authors. They called it Book in a Box back then. They've changed the name now, but basically what they would try to do is have you verbally explain what you're writing down, and then they would take your words and then retype it in their own words, so that way you don't get too much jargon in your book that people don't understand. So it's almost rewritten in more basic language. But it was highly successful. Now the point of it really was to give to newer or people thinking about investing in real estate, and it was really to lay out the foundation. Why are you buying real estate? Talking about leverage, talking about how to calculate the return on investment, how to determine whether a cash flow property is a good buy or not. Probably the most popular chapter in the book was called the $1 condo. So we talked about if you buy a property, you renovate and put in, let's say $50,000 in renovations, but the value goes up by $100,000, you might actually be able to refinance and pull out all your money out. And so they called that chapter the $1 condo, which is kind of neat. There's also a lot of people that chat about this or talk about this. Instead of calling it the $1 condo, for those of you that are interested in investing in real estate, you may have also heard of this being called the BRRRR strategy, which is buy, renovate, rent, refinance. And so that's the other terminology for this. But really, it was mostly just going to the foundational items about investing in real estate, why invest in real estate, how to know if a deal is a good deal or not. And we did touch on a few of the more complex concepts near the end, which was talking a little bit about rent-to-own strategies, buying multifamily properties, and what we call the multiplier effect and things like that. So great read, especially for those that are in the newer to intermediate investing. A seasoned investor probably will get as much out of the book, but that wasn't really our target.
Airbnb has been controversial and has been getting some media attention recently.
Yep.
What are your views on some of the measures that government is taking to restrict Airbnbs in favor of increasing supply for homes for residents?
Well, I have an opinion about government. Maybe I shouldn't say it in an open forum like this, but let's put it this way. I think that the government's trying their best to solve the housing crisis. I think the problem is, from the government's perspective, at the federal level and the provincial level, it's really hard for them to fix the problem. So federally, one of the ways that they're doing this is they're pushing more money into incentivizing developers to build purpose-built rentals, and they're doing that by having really good CMHC insured multifamily financing. So you can get up to 50-year amortization, up to 95% or even 100% financing, which is very rare, but it's possible. And the interest rates are cheaper than residential interest rates. So they're trying to incentivize developers to build more of that. But the problem is that when you start to go down the layers, to build something like this, it's not federal, it's not provincial, it's the municipal level. And where do you buy, where you build properties? And so the municipal problem is that the leaders at the municipal level are all trying to get reelected. And if they're building a condo building right next to your house, and you have the terminology is NIMBYs, not in my backyard. Hey, you know what? I didn't want you to ruin my community, and you put all these big ugly buildings next to me. I don't want to I don't want to vote for this person again. So it's creating this weird tension. So on the Airbnb side of things, what they're trying to do is say, okay, provincially, above the municipal level, let's just try to increase the number of units that are available. I don't agree with a rule that just comes out and just, slaps a bunch of people in the face, because I was reading, for example, I'm doing some research on this. I myself noticed that unit building that we use for short-term rentals in Victoria. So I have to figure out what we're going to do with that building. And I think we might actually be okay due to a couple of classification items. But there's some people that, I read a story about some lady that sold all of her retirement savings and investments off, bought 4 condos in a building, was going to short-term rent it. This was going to be her retirement strategy. And this move is probably going to devalue those units. And now she's going to have to probably sell them at probably a loss. And it's just a little bit heartbreaking that this is happening to people. So, do I agree with it? Like, I understand why the government's doing it. I just wish that there was a different way of trying to increase the supply instead of going after people that are still providing a service. And I think that the challenge is going to be, well, what's going to happen to hotel prices in Vancouver, Victoria, Kelowna? They'll be through the roof. And how does that affect our tourism? And less money now will be coming into our province. So very interesting. I'm not sure what will come out of it. And frankly, I don't think anybody really knows the answer.
Mhm. Okay. Along the same lines, we continue to hear that we have a real estate supply problem in Canada. We brought 1 million immigrants to Canada last year. All indicators are that demand is increasing.
Yeah.
It's expected that, elevated levels of immigration will continue, and, we can expect that we can expect the elevated demand to remain over the long term. Is Canada doing enough to bridge the real estate supply issue, in your opinion?
No, definitely not. No, I've read some studies that I think the provincial government was saying that they need to build 110,000 units in the next, I think by the end of 2025 was a stat that I heard, and so far they've got 17,000 built. We're severely under, and a lot of, like, from a Canada-wide perspective, it seems like we're only on track to build about a third of the required units for everybody. So it's going to be a problem. The supply problem is a major issue. When you look at the short-term rental thing, it's a drop in the pan. You're not going to see that it's going to drastically affect these marketplaces, maybe for a short term, like 6 months. But we need to solve the housing problem, and we need to be able to build more units. And it seems like a misalignment between the government and wanting to bring in a number of new immigrants, but also not focusing on the housing part, making sure there's enough housing for everybody to live in. So I still think it's going to be a problem. I think that means that in that case, real estate values are going to stay elevated. As much as the last 2 years have been really tough and interest rates going up, the demand side has decreased. Until very recently, the supply was still lower than the demand. So we still had people jumping over each other to buy the same home. We had multiple offers and subject-free offers this spring. So, until I think September was I wouldn't say a tipping point, but the supply increased substantially all of a sudden in many urban centers in Canada. And if that trend continues and perpetuates, then we might finally see that maybe values will soften a little bit for the next 6 or so months. But I really don't expect that this is going to be a long-term trend. I still think that by 2025, it's probably going to be another boom in real estate as the interest rates start to drop, and a lot of people are going to want to enter the housing market. It'll be crazy again. So,
yeah, you somewhat answered my last question there, but really, logically, taking from the themes of what we've discussed today, I would assume that would be your prediction that, in a couple of years' time, limited supply, lower interest rates, there's only one place for real estate prices to go.
100%. Yeah.
A final question for you, a final question in that case is there any economic news or data that's keeping you up at night right now?
I mean, not keeping me up at night, I suppose. The inflation is definitely a concern. Inflation affects everybody. Just affect people that are borrowing money in a mortgage. Doesn't just affect people that are in a variable rate mortgage. It affects those that have a fixed rate mortgage coming up for renewal in a year too. So it affects a lot of people. And I think that it seems like the inflation numbers are starting to come down. There's always a concern that inflation, spurs back up again and the rates go up even higher than they are right now. And so that's definitely a concern. That the reality, however, is every week the needle gets bumped around like this. Right. The jobs are weaker, the jobs are stronger, the CPI is down, the CPI is up, and the predictions are off a lot of the time. And it just is a jagged move all over the place. And it's been a long time since I've seen the markets react this much back and forth with every little data set that we see. So it's interesting to see what happens. It's not really keeping me up at night now. I think that one challenge for sure is operating a mortgage company in a time like this we were very busy trying to make sure that our clients knew what was happening, trying to help them out with how do you deal with the fact that interest rates are rising? Can you afford your mortgage? How do we help you in a climate like this? But also being in a situation where we're also closing less business. And so I think for a while there, losing a little bit of sleep because letting staff go is never a fun thing. And for a while there, it just seemed like, let some staff go, stabilize, and oh, never mind, the market's dropping again, and always having to redo that. We've stabilized and we're at a point now where that we feel comfortable, and I don't think that any further changes will have to happen. But for a while there, I think I was losing sleep earlier, like late 2022, 2023, and now I'm getting a bit more sleep, but we're not out of the woods yet.
Thank you. Okay, now really my final question for you is, where are you putting your money right now, or where are you most bullish, I guess?
Yeah, interesting. So I'll say this: I have a lot of real estate, and I'm actually not buying any real estate right now. However, that's partially because I own two cash flow businesses that haven't been generating as much cash flow as they normally have because of the market. And so I think that in times like this, it's important to make sure that you don't overextend yourself and jump in. So I'm trying to just make sure that I'm stocking cash away in case things get worse before they get better. On an aside, I'm actually working on developing some software in the mortgage industry, and that may require a lot of capital as well. But it's trying to speed up the art of getting a mortgage, develop and deliver a better customer and user experience as well with getting a mortgage. And so I actually think that that's going to be one of my key focuses in the next year or two, is really trying to enhance and focus on that side. And in general, those types of businesses do require a lot of capital to get injected into them to build it out. So that's where my money's going right now.
Excellent. Yeah. Well, Kyle, thank you so much for taking the time today and for sharing your insightful thoughts. We look forward to staying in touch with you. And to our viewers, thank you very much for joining us today, and look out for our next Expert Access Series session. Thank you, and have a great day, everyone.
Thanks, Omar.